right, it's time for me to bring in Narendra Kumar, the CEO of Value Research. Narendra, thank you so much for joining us.
Thank you.
Let's get straight to our portfolio question. Well, Neeraj has written in, Narendra, he's a 43-year-old NRI who's just moved to India, which means that he's not an NRI anymore. He's switching careers. He's looking for a job. He hopes to have a job in 6 months. In the meantime, his wife is the sole breadwinner of the family. She's a government employee. Now, Neeraj tells us in the meantime, while he's looking for a job, he'd like our advice. The couple have no children, no mutual fund investments, no health or life insurance. But thankfully, since his wife is a government employee, health insurance is looked after. They own the home that they're living in and they've rented out their second home. Now, this is the thing, Narendra. He has 1 crore rupees, which is his life savings, in an NRE account right now. He wants to know where he should invest that money. And he tells us very categorically, because this is his entire life savings, his risk appetite is very low. He doesn't want to take too much risk with this money. Now, first of all, he's going to have to, change the status on some of his bank accounts. Is it important for him to also change the NRE deposit to a resident fixed deposit, or can he hold on to it for a little longer?
He can hold on to his NRE fixed deposit till its maturity, and he should inform his banker about his change status. And the status changes. There's a technicality here that a non-resident status can still be maintained or claimed if you have stayed abroad for 362 days in a financial year. That's a technical bit. But more importantly, he should look at his 1 crore rupee accumulation very differently, which is he should split his money, the emergency fund which he needs. He should certainly go for his term cover, and it might be needed, of course, given that he has 2 houses and a not really a financially dependent wife. So his need for term cover might be less, or may not be there. But he should keep an eye on that as and when he has financial dependence. But that apart, beyond that adequate emergency fund, despite his conservatism, his accumulation will actually be going down in value if it is not invested. Right now, this is just a saving, and it is lying there in a deposit which will be barely able to manage the rate of inflation. So effectively, it runs the risk of going down in value or barely matching with that or remaining constant. So from that standpoint, he should look at his risk tolerance. And if it is going to be long-term money, I don't think there is any problem. He just has to follow a very simple method. Go for a conservative allocation. Maybe consider our conservative portfolio or consider our stable growth portfolio. Spread his money over the next 12 to 18 months, not make all the investment at one go. That itself will take care of it, and having that emergency fund will make sure that he is not getting anxious about it. Maybe 10 lakh, 15 lakh, 20 lakh rupee should be accessible and be retained in that deposit, which might be yielding reasonable return.
But Narendra, he's also asked us about tax saving. He says he does want to save some tax at this point. I'm assuming even the rent and the interest that comes out of these investments is going to be taxed. What would you like him to do? Should he also be using one ELSS perhaps along with our stable growth portfolio?
Yes, I think it's very important to save that tax, and he should. And the only entitlement or only avenue to save tax is invest up to 1.5 lakh rupee. The other thing which he could have availed, or if there is a possibility of taking a loan against his house and repaying the interest, that will be another tax break which he can derive. But if he's not leveraged, then it doesn't make sense. So he should consider investing 1.5 lakh rupee into a tax saving fund, and and he will get full benefit of that. His income will be reduced by 1.5 lakh rupee every year for paying taxes, for computing taxes.
All right, so there you have it. That's the advice you need. Keep the NRE fixed deposit to the extent that you need that emergency fund. You have to have life insurance. Keep an eye on health insurance. And Narendra, they're giving you a clear roadmap on how you should invest your money. Stay in touch with us. It'll be our pleasure to continue to help you. Let's move on to our hold or sell segment. Anish has written in. He's 22 years old, Narendra, and he has an annual income of 2.6 lakh rupees. He tells us he has a high risk appetite and a time horizon of 7 years. And he'd like to invest in mutual funds. He wants you to approve the list of funds that he sent in. And it's impressive because he's investing a large chunk of his take-home salary in these funds. Right on top is an aggressive small cap fund, the Franklin India Smaller Companies Fund, 1,000 rupees going into that fund. And I can understand why, because the performance has been very impressive over the last 6 months or so. But is that reason enough for him to be investing his money in this fund?
Yes, I would approve of his investment because if he is looking for aggressive return from such a fund and he does it with understanding, then it's fine. It has proved to be an outstanding fund. Also, looking at the portfolio, it has a strong quality focus despite being a smaller company's fund. So I don't think there is anything. And of course, he has to appreciate one thing, that the times in the market over the next 7 years will not be the same as the last 7 months. So he should have a stomach to stay with such a fund or withstand the kind of decline that it can go in between.
The next fund on his list is the ICICI Value Discovery Fund, Narendra. It used to just be the ICICI Discovery Fund. Would you recommend he continues that investment?
Yes, of course. This is not a very young fund. It has undergone a name change, a minor tweak in its name. So from that standpoint, it's not a new fund. The erstwhile Discovery Fund was always a value-oriented fund, and now in last 3-4 years, I think it has articulated and demonstrated its capability much better. It's an outstanding fund, and given that a set of fund he has, it's an alternate strategy, and we don't have too many impressive value funds in India. So it's a great fund to have in such a portfolio.
Now, I'm going to take the next two funds together, Narendra, the IDFC Premier Equity Fund and the Quantum Long-Term Equity Fund. He's putting 1,200 rupees a month in both of these funds. And I know these are funds that you've recommended on this show, that you personally approve. So would you recommend he continues that investment?
Yes, absolutely. In conjunction with what he already has, he has good diversification across various skills of fund managers, demonstrated ability, reasonable track record. And of course, the most important thing will be, he does not get upset or disappointed or stop his investments in between, because last 1 year has been very good for any such investment. The earlier 3-4 months anybody would have accumulated. So it's early days. He might feel very pleased. He might be very pleased with the returns from these funds so far. But it may not be always like this. Things will it'll be moderate, and it'll be difficult phase as well. And that is a time when his discipline will actually be the key driver of performance for his portfolio.
All right, last two funds together, the Axis Long-Term Equity Fund and the ICICI Prudential Tax Plan. Narendra, do you approve both of these investments? And given everything else he has in his portfolio, now when you look at all of it, is it a complete portfolio for someone of his age?
Yes, someone in his age, he has chosen good funds. Both tax-saving funds are also excellent funds. I would say that there's a bit of complementary holding in ICICI Prudential Value Discovery Fund and the ICICI Tax Saver. So if he wants to keep it simple, maybe he can increase his position in the value fund and drop the tax saving fund altogether.
That's the advice you're getting right now. Remember, if you'd like to have your portfolio looked at on the show, write to us. Our email ID is at the bottom of your screen. Let's take a few more questions. Vijay Kumar has written in. He'd like to create a corpus of 1.5 lakh rupees in 1 year, 2.5 lakh rupees in 2 years, and 5 lakh rupees in 4 years. He's not told us what this money is for, Narendra, but he does seem to have fairly specific goals. He wants to know if he should be using short-term funds or balanced funds for his goals. And obviously, would you like him to have separate portfolios for each goal?
If these are very well articulated and non-negotiable goals, then he must have separate investments made, or at least keep it in his mind. And for all these time frames, and the investment that he's planning, he has no scope to have equity. Maybe the money which he needs for his for the 4-year term, maybe 10 to 15% into equity might be suggested. But rest of his buckets, he can't afford, he can't have any equity. So it should all be invested in short-term bond funds.
I'm going to quickly try and take another question. Nagarajan has written in, Narendra. He tells us his children are 8 and 3 years old respectively, and he wants to invest for their future, which means he has 10 and about 15 years as a time horizon. He invested 20 lakh rupees in the Reliance Equity Opportunities Fund and 10 lakh rupees in the SBI Emerging Business Fund for his children's education. It does seem like he made lump sum investments. He tells us he's disappointed now to find that both of the funds are 3-star rated. He wants to know if he should switch his money to Quantum Long-Term Equity or to HDFC Balanced or HDFC Prudence Fund. Narendra, is there hope for him in the two funds that he's already invested in? Is it necessary at all to make that switch right now?
Best way to accumulate your savings for such a goal, which is still 10 year, 15 year away, is to accumulate it gradually. Making a lump sum creates its own pressure. And of course, I don't think the slip in rating should drive him to change his mind or change his investment. Once he has done that, and of course, his investment experience will not be disappointing so far. These funds are doing well, and they are doing not so well relative to other funds in their own category, which might be disappointing. That might be the primary reason. That is the primary reason why the funds have slipped on rating. But in isolation, I don't think these are disappointing funds. And funds do go through such rating changes or relative performance or slipping on relative performance compared to other funds in similar category. But I think he needs another approach, which is diversifying better, and ideal would have been accumulating his savings in a manner that there was no need to invest 8 lakh rupees or 10 lakh rupees at one go in a single fund. And for him, I would suggest that he'll be much better off with our growth portfolio, which will be managed. Periodically, we'll be if any change is needed, we'll be prompting him.
All right, you'd be better off using our growth portfolio. So Narendra is saying, don't pull your money out of the funds that you already have, but incremental investments, which is the way we really like you to go about making any sort of investments, whether for your own retirement or for your children, use our growth portfolio. And of course, get back in touch with us if you need any more help. It's time for our product review, and this week we're looking at the UTI Opportunities Fund. Avan is here to give us an introduction. Avan.
Thanks, Faye. Under the scanner this week is the UTI Opportunities Fund. In the last few years, this fund has been responsible for the turnaround in the fund house's reputation. The fund manager purely concentrates on capitalizing on opportunities that arise in the market and moves its investment among different sectors when the trends change. Over the past 5 years, the fund has given an average return of 27% despite its underperformance compared to its benchmark in 2 of these years. The performance otherwise has been very positive. In 2009, the fund took advantage of the strong gains, and it also protected those gains when the markets fell 25% in 2011. This fund fell only by 12%, eventually leaving big gains for its investors. The fund's low volatile and high returns nature has awarded it with good ratings. The fund has been a 5-star fund for quite some time now, and the secret behind its incredible track record is the stock-centric approach rather than a top-down, sector-centric or macro-driven approach. The fund manager is gradually increasing the large-cap exposure. In 2010-11, for instance, the allocation to large caps was up to 70%, and today the allocation has gone up to 80%. This fund may soon be reclassified as a large-cap fund. Now let's do some math to give you a better perspective. If you invested 1,000 rupees in this fund when it launched, you will have 4,243 rupees today. So should you be invested in this fund? Let's find out. With that, it's back to you, Faye.
All right, Avan. Narendra, UTI Opportunities really has made a remarkable recovery over the last 1 year. It has sort of replaced the view of UTI as a fund manager for everybody. Would you recommend that those of us who are invested in this fund stay invested and hope for better and stronger performance going forward?
I don't know about the stronger performance, but this is a well-managed fund. It has made an impact or made an impression in the last 5 years. But at the same time, 2011 and 12, it has been disappointing. It struggled to beat its benchmark, and we have seen a manager change as well. Of course, it is, despite being called an opportunity fund or a mandate which enables it to assume risk or concentrate or take a big bet in some stocks, this fund is managed very conservatively. So from that standpoint, if investors are looking at aggressive return, this may not be a great choice, because this fund has done well. It is managed relatively conservatively, and it is not, though quite in contradiction to its name, which is UTI Opportunity, and enabling objective that it can assume risk.
But the last time we talked about this fund, you gave it 5 stars. Would you continue to give it 5 stars right now?
Yes, I would slot it at a notch lower, which is also its risk-adjusted rating scale, where it is getting slotted as a 4-star fund. It has been a good fund, but periodically it has struggled.
Well, I want to ask you this about UTI in general as an asset management company. Now, we know that across the board, across most of its funds, it tends to be a conservative fund manager. For those of us who are invested in UTI, should we actually bring our expectations down to expect conservative fund management and then to expect those sort of returns? Or would you recommend that we actually go out into the market and get more aggressive funds, especially in a market like this one?
No, I don't think UTI should be looked any differently. UTI in last 5-6 years, it has been able to establish the process and demonstrated that it is a professional fund manager. The ways of conducting business at UTI has undergone a big change in the last 5-7 years, and we should not look at it with that angle. It is only valid for this particular fund. Yes, a lot of its funds are managed conservatively because of their old mandate. For example, Master Share is also managed in similar fashion. But there are other funds which are managed very aggressively. They are managed in a manner, and one should look at every product and the competing alternatives and look at it objectively from that standpoint. I would say that the fixed income funds of UTI are a completely different story. Some of them are very impressive. Many of them are extremely rewarding, and they are able. UTI is able to run them at a very low cost, and that has translated into huge benefit or superior performance of the fixed income funds.
All right, so if you have questions about a UTI fund that you're holding on to, write to us. Email ID is at the bottom of your screen. That's 4 stars then for the UTI Opportunities Fund on Investor's Guide. I'm going to slip in one very quick question for you, Narendra, and this is why a 20-year-old Sharat Kumar has written in. He's going to receive his first salary of 25,000 rupees very soon. He wants to know where he should invest that salary to secure his future. So obviously he's starting a brand new portfolio, and it's so nice to hear from someone so young. Would you tell him where you'd like him to invest the money out of his first salary?
No, one is to suggest him the investment, which I will, and I thank him for sending out the question. But I think more important thing will be he should work on some percentage which he will save every month and maintain a discipline, follow a disciplined approach to investing that money every month. Get started with a balanced fund. Though you have all the time and you will be willing to assume great risk and huge and expect rewards, but I would suggest that get started with a balanced fund and stay on course for next 1 year, next 12 months, and then write to us again, and then we will suggest you more aggressive funds or things once you have gotten used to this.
All right, and if you would like some help with your portfolio or the portfolio of a younger person who's at home, write to us. Email ID is at the bottom of your screen. Welcome back. You're watching Investor's Guide in ET now. Thank you for staying with us. We brought in Gaurav Mashruwala to answer all of your questions on your investments. Gaurav, thank you for joining us. Our first question comes in from Lalit. He tells us he bought property in Jodhpur in Rajasthan and registered it on his parents' name. Both of his parents are dependent on him. He wants to know now if he can claim the tax benefits under Section 24 and ATC, since he's the one paying the home loan EMIs. That sounds like a bit of a problem there, Gaurav. Is there anything that he can do?
Mr. Soni, the loan is in name of your parents. Now, house is also registered in name of your parents. So, for you to get tax benefit, my feeling is that no, you cannot get it, because you have to be A, the house owner, B, the borrowing also has to be in your name. Since you are just repaying the loan on behalf of your parents, according to me, you cannot get the tax benefit.
Our next question comes in from Narendra, who's 62 years old. He tells us he just sold commercial property earlier this month for 85 lakh rupees, and he wants to know where he should invest that money so he can save for his own retirement and for his daughter's future. Gaurav, there's also the question of tax and the fact that he might have to pay capital gains tax on that sale as well. What would you like him to do?
As far as your daughter's marriage is concerned, you may want to start an SIP depending on when the marriage is. You may want to consider either a debt-based funds if your goal is beyond 3 years, less than 3 years, you may attract a short-term capital gains tax, or you may want to do a recurring deposit. For your retirement, if you're already in 50, so if it's around 4-5 years, then again consider debt and equity combination. If you're going to be working for a decade or more, then you may want to continue you may want to start and continue investing in an equity based fund. Start doing an SIP on regular basis, and about 2 to 3 years prior to your retirement, start shifting that money into a debt-based instrument. You will have to keep in mind your liquidity needs and also the tax benefits that government gives from time to time.
Manish has written in, 34-year-old NRI. He wants to create a corpus for his own retirement and his daughter's education. His daughter is 5 years old. He tells us he can put aside 1 lakh rupees every month for the next 22 years. He has an insurance policy from Birla Sun Life, from Aviva Life and the Aviva Young Scholar plan. I'm worried that might be too many insurance plans. He also has a fixed deposit of 2 lakh rupees. What should he do next? Gaurav, I think he should bring down the number of insurance plans and then make a very clear allocation towards his future. What would you recommend he does?
Mr. Shirke, thanks for writing to us. There are a couple of things. You already have one loan, you have a second loan. You also have some investments in ULIP. You want to save money for your retirement and for other goals. Now, here are my recommendations. First is that you have a fixed deposit already in place. What I would encourage is that earmark that fixed deposit for your contingency fund. Number one. You haven't mentioned a lot of details about health insurance. You need to have that. Third thing is you have investments in few ULIPs. ULIPs are very expensive proposition, and hence I would encourage that just look at the cost factor, and if cost is on higher side, then you may want to consider taking some call of either continuing or terminating or making it fully paid up, or what other options are available. After doing this, concentrate on repayment of loan. It's only 4 lakhs left, so just focus on that and repay loan. Then it comes to your retirement requirement. You already have 2 houses. One house is where you are living, and there is another house that you have which should be considered for retirement. Let it grow prior to retirement, liquidate that house and use that corpus to create retirement fund. Apart from that, for other goals, what you should do is continue your SIPs, invest for long-term goals into an equity-based fund. Do not get into ULIPs again till their expenses come down on par with mutual funds, and look at equity as an asset class. So you may want to invest in equity-based mutual fund through an SIP. Also, once your loan is paid back, you will have surplus amount of EMI that should also be utilized for creating corpus for your other goals.
All right, that's a wrap on Investors Guide. Thank you so much for watching. Thank you, Gaurav, for answering our questions this week.
Thank you.
If you have a question about anything to do with your money at all, write to us. Email ID is at the bottom of your screen. Remember, 30th of August is an insurance special. To send in questions you have about your insurance policies, reach me on Twitter. Thanks for watching.